Hello and welcome to Macro by Kexelius. Many once reliable diversification and hedging strategies were struggling under this year's heightened market volatility. In today's video, we will look at 3 popular strategies that failed to protect investor portfolios amid high inflation and high market volatility. We will begin with an analogy. Imagine the Fed is still printing trillions of dollars to combat low inflation. In that scenario, the obvious place for investors to be is right under the big pipe where the money will be falling out. That place is the US Treasury market. Institutions during that time will be loading up with US Treasuries, basically US sovereign bonds and agency MBS, sell to the Fed, and get the freshly printed money in return before anyone else does. Conversely, under the environment of high inflation, the flow of the big pipe actually reverses. Instead of dumping money on the head of investors, the big pipe would drain cash from the financial market. So unfortunate investors who did not get the memo will get money sucked out from the pockets and into the big pipe back to the Fed. Therefore, it's better to see the Treasury market as bidirectional and is the interface for the Fed to impact the financial market and the broader economy as a whole. It is an interface. Therefore, it can help or hurt depending on the Fed's policy direction. Many large 60/40 funds learned this painful lesson in 2022. They started the year using Treasury bonds to hedge against equity risk, as in the decades before, under the illusion that Treasury bonds will always act as a risk hedge and a source of diversification. The results are equally painful to look at. The Bloomberg 60/40 index fell 20% year-to-date. This breaks down to negative 14.1% in the Bloomberg US Treasury index and negative 21.9% in S&P 500. By holding 60% of assets in equities and 40% in supposedly haven assets, such as Treasury securities, the 60/40 funds demonstrated that losing money can be done in a very diversified way. About 4 years ago, I had a guest lecture at a local non-profit university where I presented this very same idea of concurrent treasury and equity weakness. The class found it interesting, yet head of the economics department found it impossible to believe where equity price would fall, yet the bond price, the treasury haven price, doesn't rise to hedge that loss. I guess some old textbooks said so. But then again, the market is always evolving, and we now live in the future. Now, let's do a simple thought exercise. Imagine there is a successful hype artist somehow gradually convinced 10 million people to buy into the same basket of randomly selected securities. Then, the hype artist was exposed one day. Suddenly, 10 million people all trying to panic liquidate their portfolio. This will create strong correlations between previously less correlated assets. And the same thing happened at the UK pension crisis. The US investment-grade corporate and UK sovereign bonds are part of the consensus pension trade. Then, as asset managers faced margin calls and had to trim their portfolios across the board, US IG and UK gilts became increasingly correlated as they sold off together. The idea being previously less correlated assets may become more correlated at times of financial distress. Evidence of rising inflation by late 2021 led some investors to expect gold to outperform other asset classes. But this view is not common among institutional investors. Most contemporary asset managers no longer see gold as an all-weather inflation hedge. Instead, is now commonly seen as a nuanced expression of decline in the reserve currency's purchasing power. When the Fed was easing and printing money, gold did well even when inflation was low. This reflects decline in dollars' purchasing power, for it would take more paper money to buy an ounce of gold. Equity and real estate did well in the same scenario. When the Fed was creating $120 billion of new money every month in 2020, it took increasingly more cash to buy assets with limited supply, such as fine art. Now, the Fed is tightening and draining cash from the financial system via the bond market. Gold, the anti-dollar, weakened even as inflation reached the highest level in 40 years. Therefore, gold is a conditional inflation hedge that will do well when the dollar loses purchasing power amid high inflation, such as a scenario of the Fed giving up on fighting inflation. There are other examples where past diversification and hedging strategies struggle in the present. The financial market is constantly evolving, and we must evolve with it rather than memorizing textbooks written at a time when the central banks were far less active in financial markets. Thank you for watching, and I'll see you at the next episode. Thanks to our wonderful institutional clients and supporters like you for making this video possible. Please visit our Patreon for daily market updates and live Q&As.